All right, welcome to another session here tonight. This is a meet and greet with Veloce Capital. I'm your host, Pascal Wagner, and I am here excited to introduce Mustafa Ladha. Welcome, Mustafa.
Hey, Pascal.
Tell us your name.
It's Mustafa, but that's close
Mustafa,
enough.
I knew that.
Thanks, guys, for joining us. Appreciate the time and looking forward to getting to know you all a little bit better.
Yeah, cool. So Mustafa is gonna walk us through a little bit about his firm, who he is, the types of deals that they do. And again, this is kind of like a low pressure situation where you can learn just by kind of watching and hearing a little bit of a casual conversation, watching a presentation about what it is that Mustafa and Veloce Capital do. I find that these are some of the best ways to just get to know the space and the industry and the players. And I'm excited for Mustafa to show us what they do. So Mustafa, take it away.
Yeah, I look forward to it. Thanks, Pascal, for the opportunity. What I'll do is I'll start by sharing my screen, and then we'll take it from there. So yeah, very simply, my name is Mustafa Ladha. I work for a firm, Veloce Capital. What we do is very simply invest in real estate. And as we go through the presentation, and Pascal, feel free to stop me anytime you have any questions or anyone else. But really, as we go through the presentation, you'll see that real estate is a pretty big space, and there's a lot of different things that you can do in the space. And the goal here is really just to learn how you want to make money. And for a lot of people, that seems abstract because sometimes the goal is just to make money. But how you make money, the tax implications, the liquidity, all of that comes into play. And as you become a more sophisticated investor, it becomes more important to understand the different implications. So very simply, we'll start off with a disclaimer. Anytime you have any of these presentations, there always should be a disclaimer, basically telling you that these are projections. And Pascal's, he puts out a lot of content, so you know that all of these things are projections, and that we as investors need to ask tough questions and need to really understand how the numbers are based and what breaks the model and things of that nature. So that's why you always want to look at the disclaimers to see what are they actually saying. And I've kind of left a QR code here. If anyone's interested, more than happy to set up time to talk through your specific situation or dig a little deeper on the strategy or anything that I say in this meeting or any of the previous podcasts you might have listened to. Any questions you have, feel free to book some time on my calendar. So with that, I'll talk a little bit about our firm. It's a privately held real estate investment firm. We invest in real estate primarily in New Jersey. We do have developments and properties in Georgia and Maryland. We've done over $1 billion in transactions, over 1,000 units ground up, and over 3,000 units value add. And if any of these words sound confusing, I'll try to get into it as we go through the conversation, the presentation. But very simply, we invest in multifamily real estate. And with that, we look at 3 different approaches. We're looking to manage risk. We're looking to grow investors' portfolios. And we recognize that investors are coming to real estate because they're seeking diversification. And what we look to do is we look to understand the risk profile of each investor. Are they looking for cash flow on a more monthly basis? Are they looking for growth on a more annualized or yearly basis? Or are they looking for tax efficiency? So typically these represent different phases in people's lives. Initially, people are looking to replace their day job income. So maybe they're looking at cash flow or growth. Then when they're making a lot of money, let's say, 500K plus, but for some guys, as much as 150K plus, and they're frustrated paying so much in taxes, they're trying to figure out, is there a better way to make money? And that's typically what takes people away from the stock market and into real estate, because in the stock market, you only make money when you sell stock and realize a taxable event. But in real estate, you can make money through rental income, which when structured right, can result in a negative K1 and tax efficient income. You can also make money through refinancing. And then you can make money through selling. And selling is really that taxable event that you look to defer as much as possible with things like a 1031 exchange. So kind of continuing with the track record, we've done over $1 billion in transactions, representing over 1,500 transactions. We have well over 150 million in management, and we have over 30 years experience as a fund.
Hold on, I'd love to stop you there for a minute, and feel free to push me out if you're going to cover this. But when did you guys start?
We started about 14 years ago managing. So Veloce Capital is actually a family-run business. It's run by my family. We started about 14 years ago. I got involved in the business about 6 years ago in 2018. And basically, we started out managing our family capital. Then we grew to friends and family. Then when I got involved, it was kind of more of a democratized finance type mentality. Like, how do you take something that's only available to ultra high net worth individuals and scale it down to the average investor looking to invest, 5K? How do you build out that strategy? And is there really a strategy there? Like, I'm sure, Pascal, for you, you remember those days in 2018 where it was like every year the top crowdfunding platforms were different. Regulation was new. There weren't that many players in the space. And it was fundamentally, do these small retail investors, do they represent a large pool of investment capital? And is it scalable to really create a product around them? And are they really looking for an investment product? And so that was really the mentality for me. My base has been built on WhatsApp. I've raised over 30 million on WhatsApp. And probably another couple million on other social media platforms as well. So really it's fundamentally from people who are working their W-2 job and they're looking to make money outside of that.
Love it. Cool. Keep going. I cut in.
Sure. And yeah, Pascal, any other questions you have or anyone else, just feel free to just stop me and jump right in. So yeah, I mean, in terms of key markets, we're a bit abnormal in the sense that most real estate investment firms focus solely on the Sun Belt, your Georgia, North Carolina, South Carolina, Florida, Texas, those types of markets. For us, our bread and butter is New Jersey. And fundamentally, our mentality, at least with real estate investing, is invest in a strategy and position yourself so that you're very dominant in the market. And sometimes, traditional pain points are actually opportunities. Like New Jersey is an expensive state to live in. It's the most densely populated state. What does that mean? There's a lot of people per square mile. It's outside the largest metropolitan area. What does that mean? People have jobs and people are making money. So New Jersey isn't viewed as like a cheap state to live in. And it's traditionally viewed as not landlord friendly. It's traditionally viewed as high in property tax. But in that, there's an opportunity. And that opportunity is literally called an opportunity zone, where you can invest in areas where the government at a federal, state, and municipal, local, city level are looking for developments, right? But they're not developers. So they need to incentivize regular people like you and me to get into the market. And they do that by reducing property taxes. So you can build an $8 million building in certain markets in New Jersey and pay $2K in taxes a year. Meanwhile, my single family home, let's say it's worth $1 million, I'd be paying anywhere from 17 to 35K a year in taxes. And my single family home isn't generating revenue. For us in the market we invest in, the average inventory age is from the 1950s. So it's quite old, over 70 years old. 70% of that inventory is pre-1940s. So you have very old inventory. You have a city that's pro-development and pro-rezoning. So you have a really attractive opportunity to add value to the neighborhood, to bring nicer apartment complexes so people have better places to live. And fundamentally, everyone is working in lockstep because the city views it as you're executing on their vision, which is a very strategic way to position yourself. And it's important in investing to position yourself in situations where everyone wins. So for us, there's, 3 ways I typically break down this conversation. Income fund is really for people looking for consistent income, cash flow, new investors, or people in retirement looking to supplement their Social Security. Equity fund is typically where we're looking for more of a higher annualized return, so year-on-year, cash-on-cash return. And private syndications are more customized to the investor's goals. Typically, they're high net worth individuals or people who are looking for something outside of the fund structure. Typically, the private syndications are where you see more capital invested, but it's usually one of those situations where people do the income fund, the equity fund, and then private syndications on top of it, because the private syndications are where you get those negative K1s or that tax efficiency. So this is a project that I thought would be interesting, maybe Pascal, for you and I to discuss, and anyone to, on the call to jump in as well, because it's really a situation that kind of circles back to the disclaimers for me, in the sense that this was a syndication. The idea was that we're buying land, rezoning, developing, refinancing, renting out. Kind of like a cookie cutter strategy for us. As I mentioned, we've done over 1,000 units like this structure. And for investors, there's many ways to get involved, but in this one, it was an end-to-end type project where they're getting involved in the beginning, pre-rezoning, and they're holding this for 10 plus years. Originally, it was projected to be a 15-unit development, projected to take 24 months. And then the investors would own this asset for free. They'd get their money back. They're investing $575K. They get a projected return of $720K at the end of 24 months, and they'd own equity in the asset. So, I mean, Pascal, I know you see a lot of deals. Do you typically see that type of timeline where in 2 years you get all your money back plus profit and continue to own equity?
Yeah, I mean, I think back in the day, maybe like in the last decade, that this is like a BRRRR strategy, right? Pretty like, I wouldn't say common, but this is like where people would focus. I think nowadays this is a screaming deal. I think I would love if you could dive into the opportunity zone part a little bit more, because I think that's something that's unique. That unless you're investing with an operator who focuses there, like that's not well known, and also I think that's something that's unique to you. You can go to not any. I think it is remarkable that you can get all your money back out of the deal like you're talking about here. But I think the kicker, which is very interesting, is how do you get that type of project to be tax-free? And it may not be this project, right? That specifically fell into that opportunity zone, but yeah, I'd love if you could kind of talk through that.
Yeah, sure. More than happy to. So very simply, with the opportunity zone, what it is it's not like just anyone can get it, in the sense that the city is not giving that opportunity to the guy who's doing a BRRRR, right? A BRRRR is simply when you're buying, renovating, renting out, refinancing, and repeating, right? So if I buy an old house that's that 1940s inventory, right, which 70% of the market that we're in is that vintage. So I'm buying, let's say, a 80-year-old house. I'm slapping some paint on it. I'm putting in new flooring. I'm changing maybe the kitchen, the bathrooms, things of that nature to add value. And then I'm refinancing. In that situation, I bought that property. Maybe it's a $575,000 house. The taxes on that property are probably close to $12,000. Now, if I go and I rezone the land and I build an apartment complex on it, the taxes drop from $12K a year to $2K a year. And in this case, this project is a $5.7 million valuation at the end of the project. So it's one of those things that the asset is worth a lot more. The taxes are a lot less. If there was no tax abatements, conservatively, the property taxes would be closer to, let's say, $50K, hypothetically. And I'm just throwing out a number there. But that represents a $48K a year savings on your net operating income. So your cash flow is that much more. Your asset appreciates that much more. And you're able to refinance that much more money out. And the thing is, every time you refinance, like in this project, right, investors are refinancing, they're getting $720K back. That money's tax-free.
Right.
And then you're cash flowing. And let's say you go with standard depreciation, you're writing off this asset over 27.5 years, you're getting a small negative K1. So your cash flow is positive and tax-free. Every 3 to 5 years, you're raising rent and refinancing. because you're raising rent every year. So there's enough equity built up between 3 and 5 years that you can refinance. So it's one of those things that very early on, you own an asset, you doubled your equity because you went from 575 to, let's say, 1.4 million in value. You're not taxed on the 720K, and that's money in your pocket. You're not taxed on this 680K, but you also can't access it because it's the equity that's in your building, right? Your percentage of that 25% that you weren't able to get a loan on.
Right.
The bank would give you like a 75% LTV, loan to value, right? So it depends on the investor. Like for somebody who needs money today, this lack of liquidity is problematic. So they would prefer a project where maybe you're selling the asset. But for most investors who are investing in this strategy, it's fundamentally to say, hey, we want assets in an appreciating market. We want to hold long term. We're fine with, getting our money back in 10 years, but now we're seeing a structure where we can get our money back in 2 years. What does that look like from a compound growth perspective? And Pascal, stop me, or anyone else, stop me if you have any questions.
Yeah, I wanted to dive in where I think this is interesting because this covers this concept of the velocity of money, where the dream is what you're talking about here. Like, I don't really care if I still have equity in the property if I got all my initial capital back. And yeah, I mean, you mentioned here you might get some sort of ROI. You might be able to pull even more money out than you originally put in the deal, but now you're getting kind of infinite returns on, you don't, like, technically there's still equity in the deal, but all of the original money that you invested is out and it's still cash flowing and providing you returns, which I think that's, imagine if you stacked 5-10 deals like that. You invest 100K and in 2 years you get it back. And you're still getting, a couple grand a year in cash flow. And now you can reinvest that 100 grand and rinse and repeat. And so I think that's pretty unique about this.
Exactly. And I have a client like that. He's looking to build $100 million portfolio. And it's very simply that strategy of like, hey, Mustafa, if I invest every year, or if I invest in multiple projects every year, what does my 10-year chart look like? Because when I'm, 34, I just want to be coasting off of, a very strong portfolio that's very, inflation resistant, that's, agnostic of the market or independent of the market, because fundamentally people need to live somewhere. And when you're positioning yourself outside New York City, in new construction, in an opportunity zone, it's very strategic because the opportunity zone is temporary. They're using it to promote development. But at some point, the market will be developed and it will no longer be a C-class market. And you touched on track record and how long we've been investing. Because we've been in this market for over 14 years, we've seen it as like a D-class market. We've seen it become a C-class market. And now in the next 5 years, it'll probably be a B-class market. So if you get into a project like this, and 3 years from now, everything around you is much nicer, the value of your asset also jumps because everything around it has become nicer and the whole neighborhood is now nicer. And that's what we're doing across the whole city. But that being said, like I mentioned with those disclosures in the beginning, this is all a projection. And the reason why I mentioned this project is because things, do go wrong. And that doesn't mean that it's necessarily bad. It just depends on how things play out. So in this situation, we were starting out, we bought land and we were going to rezone. That was the first risk. We bought land that's not rezoned or not shovel ready, depending on who you talk to. So we went and we got it rezoned, but we didn't get 15 units. We got 11 units. So we got it rezoned for less, which is obviously problematic. But that's when it's important to have a strong team, and it's important to be able to pivot, and it's important to be able to understand what can you do in your market. And if it's the first time you're doing a development and ground up construction, which is not an easy field to be in, then you're going to be presumably scared and concerned. So in our situation, we're now no longer building 15 units. So the projected value decreases. We go back to the drawing board. We restructure the construction budget. We reconstruct the projections. And long story short, for investors, we're ahead of schedule. It's now As of the last update, it's now October 2024. As of the, this recording, it's now November. We're about, let's say, about 19 months in, roughly. And investors are on track to make even more than 25% return on their money. They're on track to make 65% because a couple things happened. The value dropped. The projected value after construction dropped by $1 million. The projected refinance dropped by about $700K. Closing costs dropped by about $20K. The projected loan, or the actual construction loan that we took out, dropped by $1.3 million. That's huge because we're building less units and we restructured our build. We were able to massively save on the construction budget. And that trickles to us as well as investors. So for investors, their projected profit is now $373K off of a $575K investment. So they get their $575 back and they get another $373K and they continue to own the asset. So for them in the next 3 months, they should see a liquidity event early 2025, which will represent probably around a 21-month investment term, so a little under 2 years. They'll make more money than we projected, which isn't always the case. All investments carry risk. But it's a cool situation for investors where something went wrong. We didn't get the unit count that we were looking for, but we kept the project moving along and we were still able to hit the return profile for investors. And you can see like the before and the after, right? It's a bit small and I apologize for that. But basically this is like your local bodega, your local 7-Eleven. There's a park right here that you can't see that well. And then there's a building in the back. And now we have this nice development. Park is still there and the same building in the background. Pascal, I'm sure this is, bringing up.
How do you, I mean, something like this is fascinating. I've heard stories like this, but now that I have you, how do you rejigger a construction loan by 1.3 million and come out ahead?
Good question.
Like the thought here is like, what did you not see when you first did the project that you only saw after things went sideways?
So it's a couple of things. Like sometimes we think that bigger is better, but that's not always the case. Especially in very densely populated markets like ours, we're able to put up 6 to 42 units very quickly. And our larger complexes take much more time. Sometimes with larger complexes, the ROI profile is not as favorable, but the dollar amount is. Now, in this situation, it was one of those situations where our hand was kind of forced by zoning, right? So when the zoning changed, we had to go back and we had to look at, hey, what does the unit count look like? And what if we change those units to maybe be bigger units? And so now we're charging more in rental income, and that's going to give us a higher value, and we're building less units, so we'll be able to save on the per unit cost. So those are a couple factors. Also interest rates is another factor. And it kind of just comes down like to the project and trying to keep costs down as much as possible while recognizing that there are things outside of your control. And your question was specific to construction loans. So touching on that a little bit, you get your construction loan after the land is rezoned when you're putting together like your draw schedule. So at that point, right, this projected construction loan was before land was rezoned. It was based on a 15-unit build, based on prior data, which is based on like how much it was costing us to build through COVID and through supply chain issues, where our cost per square foot was higher, right? Still, pretty competitive, but let's say, 150 a square foot or so.
Right.
Which is very competitive in our market. Most builders are building at 200. Then a couple months later, we're able to get it rezoned, and some of the supply stress that we were seeing is now less. So now we're able to build at a 130, 140 a square foot. So that's another factor, right? Just having very lean operations, which isn't easy necessarily, and it's not always reflected in the numbers, but it's there on the pro formas and the underwriting. And it's to say different builds, like this is built in wood and like stick, versus a construction, like a concrete build, which would be much more expensive. So those are a couple things behind the scenes, Pascal, and I hope that answers your question.
Yeah, that's good. I like it.
So kind of circling to different structures, because this same project could have been structured a couple different ways. We didn't need to syndicate it. We could have just invested through our income fund. Investors could make a fixed return, anywhere from 10 to 13%, and we would keep the upside. Now, what does that mean for a project like this? That we're typically loaning out the money to the developer, right? That's one approach. And we're getting a fixed return. And this 575 that he's taking for the investment, he's paying us a fixed return on that. And we're paying that return to investors, and it's collateralized at the fund level. So that's something like an income fund. And this is really how it's structured, right? It's for accredited investors only. Typically, that's somebody who's making more than 200K a year for the past 2 years. There's a couple different definitions. Could be more than $1 million in net worth, more than 300K between him and his spouse, etc. The reason why this fund is a good option is it's a very short investment term of 12 months. You have the option of high liquidity as frequent as monthly. Typically, that's what I recommend for people. And you can make between 10 and 13%. It's a sliding scale based on how much you invest, but it's good for non-retirement capital because that grows tax deferred. Sorry, it's good for retirement capital, excuse me, because that grows tax deferred. It's good for non-retirement capital because you're not married to a certain structure. It's a 12-month term, kind of like a CD or like a dividend stock, where you're making good liquidity, and then you can exit at any point. And I'm sure, Pascal, you've come across a couple different like income or debt funds in your time as well.
Yeah, I'd love to dive in. So once you're in so the way I kind of think about this is it's an initial 12-month term and then you can get out at any time, or is this like you get in and then you keep, like, at the end of 12 months you either get it back or redeploy, and then it's in there for another 12 months? How do you think about the liquidity?
So typically I think about it as the latter, but it really depends on the client. Like if the client or prospective client is new to working with us, this is a great option where you can get out quick if you want. Because sometimes people, and I'm sure you come across this a lot, Pascal, and maybe someone else on the call, but sometimes this is the first time you're investing in real estate and it feels scary because you have the stock market or Robinhood or whatever brokerage you're using where you can sell whenever you want. And then you have real estate where typically the fund is telling you, the minimum investment period is 5 years, or we have a 5-year strategy and a 5-year approach with 2x multiplier in 5 years, or 10 years, depending on the fund. So this is that option to say, hey, like, how can I get real estate exposure, a strong return, kind of know what I'm signing up for, and know if this company is actually able to deliver without being locked in long term. And that's why I recommend the monthly option, because then you're seeing that monthly cash flow. So there's that one group who's like new to investing in private placement or investing in things outside the stock market. The second group is those people who are in retirement, and they might, have a lot of capital, have a lot in the stock market, etc. But the stock market isn't giving them enough liquidity through their dividend stocks typically. So they're saying, hey, how do I supplement Social Security? Because I don't want to sell my stock and realize a taxable event. I'd rather just leave it there. And it's a common mentality. Like for some people, it's hard to buy a stock when the price goes up, and it's hard to sell when the price has appreciated because they're thinking about future appreciation. So this is one of those good strategies to really prioritize cash flow and just living off of the income rather than having the nest egg deplete, if that makes sense, Pascal.
Do you have an idea? Can you tell us about maybe the size of the fund, maybe typical loan that the fund makes towards projects? I'm assuming this income fund is a debt option that on your portfolio. So you're not going out and loaning the money in the income fund to a bunch of other real estate operators. This is more of you're using the income fund to fund debt within your own portfolio.
Correct. So this fund represents conservatively about 65 million we have in this fund. And then we would go out and do a project like, let's say, this one, right? And we'd say, okay,
Right.
for like 2 years, we're holding this. We're going to return 25% over 2 years, and we're going to recapitalize all of our money. So if we have enough capital on our balance sheet that's costing us 12.5%, it makes sense to do this project through the income fund.
Right.
Now, when the numbers change, and obviously we also have our own capital in the income fund as well, so that brings down the cost basis to some degree from our perspective. But when the pro forma or when the projection changes to 65, now we're looking at it like, okay, hey, we're in a position where we can afford to have paid out or to have gotten this 575K at a cost base of 32.5%, which across the fund makes all of our projects more sustainable. But ultimately, this is higher than what we would underwrite at, right? So it's saying, hey, base case, what do we need to be making in that income fund to be able to pay investors, 13%? Typically, we want, a high single digit, low double digit buffer. And then we're going for those types of projects through the income fund. And then if it doesn't hit that metric, we have equity funds. And these equity funds are all performance-based splits. We have two different structures. And also, like I mentioned, my calendar link is here if you want to talk about your specific situation. But Pascal, circling back to your question, not every fund, not every investment makes sense through that income fund. Some of it's better to do a profit share. And that's, typically a 70-30 with no management fee, which also in our space is a bit irregular. There's no asset acquisition fee or refinance fee or anything like that. The minimum here is 25K, again, for accredited investors. The minimum term is 2 years. And that aligns well with a project like that Governor Street project. And that's really why we have that minimum to say, hey, just like in the income fund, you have a minimum 1 year, and then you can sign up for another year. In this one, you have a minimum 2 years. And then after 2 years, you can exit whenever you want. And it takes us 3 months to get you your money back, basically to exit a position, to liquidate and pay you back your initial investment plus whatever profit has accrued. So that's a good option for people.
What made you decide? I think not taking fees is really rare. Because I mean the logic, I think when you think about investing in a deal, you want to make sure that there aren't too many fees to get you before you get feed to death. But on the opposite side of the spectrum, I always think that you also want the operator to have enough fees so that they have enough money to run their business properly and hire the right team and people. And I guess like a caveat is I have seen unique operators. I believe like Black Swan is a company that doesn't have many fees, and they're mostly all back end, and kind of their logic is, they make enough money in house because they've invested their own money, and kind of this is to help them grow and to the next level. How do you think about this?
I think fundamentally, Pascal, it's similar to what you just described in the sense that we view it as we're investors first, and we want the best deal out there, and we want everyone to make money. And because we're very confident in our ability to deliver, and we recognize that investing can feel scary, and by virtue of feeling scary becomes scary, we want it to be that everyone's incentives are aligned. What business can operate without making money? None. But if you talk to anyone who's buying a product, no matter how much they want the product, if it feels too expensive, they're going to hold off. And that's to say that, real estate investing isn't for everyone, but how can you democratize a product so that it is for everyone? And it's to make it overwhelmingly favorable for the investor to say, hey, listen, you can invest in this and you can make a lot of money, but all investments carry risk. And I'm not in a position to guarantee you profit because that's illegal. and because I know that there is risk in investments. But I am in a position to say, hey, listen, if you lose money, I've lost time. I worked hard to make you money, and I didn't make you money. So we've both lost together, and it might feel like your $1 that I lost you is insurmountable, and I agree with you. It's not okay to lose $1. But on the flip side, I worked a year for free. So it's to kind of, to the best of your ability, align risk and reward, and to say fundamentally from our perspective, we've invested our own capital in deals like this, right? And all of that being said, I'll transition to a different model if that's okay.
Yeah.
That does have fees. So this one is an 80-20 profit split with a 2% management fee. And the idea here is we're giving more profit to the investor, but we have a fixed fee. And the reason why we have a fixed fee is that this is open to everyone, accredited and non-accredited investors. We have a dealer broker that does KYC, like know your customer, know your consumer, and AML, anti-money laundering. So we have a high degree of transparency. This fund is listed on the SEC website, which is abnormal for real estate equity funds. And Pascal, you see more deal flow than most people, so you can, verify the veracity of my statements.
Is this because it's structured as a Reg A investment?
Exactly.
Okay, so for everyone listening, when you get into this world, there are I think 3 most common types of offerings that the SEC has a lot of rules around, and the first and most common one that you'll come across is the Regulation D. They're all Regulation. Actually, they're not all Regulation D, but the 3 most common are a Regulation D 506C fund, and that basically allows any real estate operator to advertise their deal. And if you see a real estate online, whether it's through ads or on a platform, it's likely that it is a 506C if they are only offering it to accredited investors. If the other one is a Regulation D 506B fund, where it's allowed to non-accredited investors, but those operators are not allowed to go publish those deals publicly. And so unless you know of an operator like Mustafa over here, at Veloce Capital, and that they have a couple that they do deals where they allow unaccredited investors or non-accredited, you just won't hear about those deals. And so the exception and the reason we're talking about this one here is this is what's called like a Reg A style D. It's basically a different legal collection that the operator chooses to make for a specific fund, and it allows them to take money from unaccredited investors, with the caveat that there is significantly more regulation. And so just a little educational nugget there, but great to see that you have one.
No, I love it. I love that background. And that's why I don't talk about performance data here. Like, I could talk to somebody about past performance, but because we're on a webinar and it's the first time I'm meeting some people, it's better to be a bit, conservative. But when you talk about a Reg A, I can literally say, hey, listen, this made 17% to investors last year, right? This product, and this product all invest in the same strategy, but how you make money is different in terms of how the nuances of how it's written up. But fundamentally, all 3 of them are investing in the same style, the same 15-unit ground up construction in the same market. So it just becomes a matter of, how do you want to invest? Are you somebody who's very risk adverse? Then this is the right option for you. It has a lower minimum, $5,000. It has monthly statements. The SEC has audited our financials. It's listed on the SEC's website. You have annual audits, which this one has as well. But it's a good option for people who want specifically those monthly statements. Like, you want to track how this is doing on a monthly basis. It's good for, investing through your retirement money as well. So it's a nice option for people to get started. And then typically what we see is proof of concept. As people get started, they have a good experience, they invest more, their portfolio scales more. And that's really one of the reasons why we launched this. We had, positive track record with investors who started small and were accredited, and some that were non-accredited and started small, but in a 506B, which can be limited to 35 non-accredited investors. So we launched a Reg A Tier 2, where we can raise up to 75 million, as low as 5K intervals, to really say, hey, fundamentally, you don't need money to make money, but you need to kind of start somewhere, and you need to be investing, and you need to invest in strategies that align with your goals. If your goal is asset-backed investments that are not correlated to the stock market, this is a good fit.
Question here. I would like to confirm, I don't know if I heard it incorrectly. Did you say audited financials?
Yeah.
Do all of your funds have audited financials, or just this Reg A one?
This Reg A one has it. RMSPV one has it. RMSPV one also has a fund administrator. This one also has a fund administrator. So it just depends on the fund and how it was set up. So to answer your question, not all of them, but this one does. And and having it as a mandate as part of the Reg A.
Yeah, I mean, I think just a caveat that I think I would share to listeners is that, I don't think that funds or operators that have unaudited funds are necessarily red flags, but it is an incredible sign when you do see something that is audited, because it significantly reduces the risk for the LP when investing with an operator, right? I think, when you hear about a lot of these scams or ways that people get wrecked, is because they've invested with someone where it's not often being checked, are they actually doing what they said they're doing with the money? And so I think that's actually just a big plus here for you, and actually not something I knew. So I wanted to make sure, if I heard that right, that we called that out and give you guys a +1 there.
No, I appreciate it. Thanks for the love, Pascal. So yeah, then we get to the fun stuff, which is private syndications. Private syndications typically are not audited. Typically, even in this, you own the asset, but this is a fund where you're diversified across multiple projects. Typically, in a private syndication, it's one project, right? So this is one. It's the Armory. You could Google the Armory, Paterson, New Jersey. It'll come up. It was one of the projects that the mayor of our city, cites when he was running for re-election. So anytime you have like positive publicity like that, it means that everyone is kind of working in tandem. Everyone has the same vision. And in this case, it's to bring luxury, class A apartment complexes to the market. And if the market is a C-class market and you're building B and A-class product, once you've built enough, the market changes to a B-class market, and then everything is worth even more than before. So this is, a build to sell type model, projected IRR of 41%, which works out to be a 98% cash on cash return. This project will probably sell beginning of Q1 2025. At that point, we'll have firm numbers and we'll see how we did. But this is a good example of a project that we built through COVID, right? Just like in that previous governor example, we were mentioning how, we were able to restructure the budget so that we were able to save money. This is a situation where things got more expensive. Concrete rose in terms of cost and things like that. But we structured the deal in such a way that, it didn't negatively impact investors. And because rent has gone up so much over the past 3 years, there is a projection, and there is a possibility that they'll make even more than 41% IRR, which anything above 20% IRR in real estate is a very good return. So obviously this is projected to be a very, very strong project.
Yeah, I mean, I think anything 15% above is a good return. Yeah, no, it's incredible.
But like we were talking about with audited financials, right? You own the LLC owns the real estate. Every year you're getting a K1. there's no point to do audited financials from our perspective as a GP, just because it adds more expenses unnecessarily to a single asset investment. But it's one of those things that we're always talking to our investors because they're our partners, right? So if they have concerns or something, we're looking at it, we're taking it seriously, and we're saying, okay, what can we do to mitigate risk? And one of the things we did a couple of years ago was adding a fund administrator, especially on the fund side, to review all of the transactions, to really protect investors, things of that nature, because audited financials once a year is nice for those people who are looking for it, who know what to look for, and who have a finance background. But getting those monthly or quarterly statements, anyone can read that, and it's really relevant to your portfolio. So I think anytime you're investing with anyone, it's important to kind of understand what are they doing to make it easier for you to understand how your investments are performing.
I think that there's, when I got into investing in passive investments, I wish that someone told me about that you don't need to go for the biggest, riskiest project first, right? I think as I'm talking through this with you, it's a big reason why I like these debt funds are that they are low risk ways to invest with an operator, start getting returns, and see what that relationship is like. What kind of reporting are you getting on a monthly or quarterly basis? What are you, and if you do that in these more audited, when you're first investing, what you're trying to do is reduce all the risk. Whenever you do something new, you are inevitably going to make mistakes, right? Because you just don't have the battle scars to know what to avoid. And so I think, when we compare this project to the other ones, if you're new with an operator, I wouldn't, these might be enticing to you. There is a lot more, it's higher risk, higher reward because you are investing in a single project. And look, like if that's the way you like to invest, like, by all means, I'm not saying, don't hop into one of these with Veloce Capital, but more of what I think I'm getting at is, there are all these different options. And if you're trying to figure out what it is, like if you want to be investing with Veloce Capital and have them be one of the operators that you give money to diversify your portfolio, you don't necessarily need to dive in at the highest risk of these, individual syndications. You can work your way up with small amounts in audited funds where you have the ability to pull your money out. And then once you've kind of like built that relationship and that trust, and that the Veloce Capital runs a tight ship, then you might feel more comfortable jumping in with these individual syndications. Have you noticed that to be a trend, or is that not a trend with your firm at all? I'd be interested.
I think it is and it isn't a trend in the sense that I'm risk averse. So I attract people who are risk averse. I attract people who want to get into the nitty gritty. And the reason why they like syndications is because we can pull up a pro forma and talk projections and talk underwriting and talk assumptions and break the model. And both me and the person I'm on the call with will love to do it. That ability doesn't exist in the fund because the fund is a blind fund. We're not telling you, hey, we're going to buy this asset, we're going to exit at this, we're going to do X, Y, Z, because that's not how the fund is built. But I recommend the fund because of the diversification. So typically, it kind of comes down to product and strategy. Ground up construction, which is a lot of what we do, is viewed as high risk. So rather than telling somebody who's a new prospective client that it's not high risk, I say, hey, it's viewed as high risk. And here's the 1,000 units we've developed. So we have a lot of experience. So we know what we're doing. We've done over 400 rezonings with a 98.5% success rate. So we're very good at what we do. But traditionally, this approach of investing in real estate is high risk. So we kind of need to peel back the layers. Like you mentioned, the income fund is one of our lowest risk options. The other lowest risk option would be something like this, which is value add. So this is VCAP X LP. It's basically 10 assets that we bought. And they're all value add. So we bought it in the sense that these are assets that we built, we refinanced, we recaptured all of our initial investment, and then we sold equity to LP investors. So instead of getting involved at the land stage, which was, let's say, Governor Street, you could have gotten involved in phase one, which was the land, this building. You could have gotten involved in phase two, which was Armory, where the land was rezoned. So that represents less risk. Or you can get involved in phase three, where the asset is already built and rented out. This represents the lowest risk and even lower risk than the income fund, because now you're investing in a value add strategy, but the asset is like, 2018 to 2024 vintage. Now, you, Pascal, are a seasoned investor. So what kind of CapEx are you expecting on 2018 vintage?
Not much.
You're not changing the roof. You're not changing the AC. You're not changing, the tankless water heaters or whatever. There's nothing that you really need to spend on. So if your CapEx is low and you're buying well, then you're looking at strong cash flow and strong return. And now the second question that I'd ask you, Pascal, is fundamentally, if you're in ground up construction, your cost of construction must be lower than the appraised value. So you can structure a deal like this where investors are getting in 80 cents on the dollar. So now they're walking into positive equity day one. They're walking into a preferred return, less than maybe the 10% that they'd be making in the income fund. But, they'd be probably making around a 6 or 8% return, maybe 6 to 7% return on a yearly basis, paid out monthly, get a negative K1 every year. And then in year three, there's a refinance event and you get all your money back. Plus in this project, a projected 28% return. So this is, not too different from the Governor Street example in terms of strategy and approach. The difference here is you're getting cash flow every month, which reduces your risk profile. This is already built. This is already rented out. The numbers are more firm. So to answer your question earlier, Pascal, I think it's one of those things that this strategy attracts a lot of investors looking for tax efficiency, because a normal fund is saying, hey, this is what it appraised for, so this is what the value is. We're saying, hey, this is what it appraised for. Here's a 20% discount that we've negotiated and structured for LP investors to join us at this phase. And then we take that capital and do more ground up construction. So we just continue to increase the value of the whole city. And then after a couple of years, the value of all of our assets are worth much more because the whole market has become nicer. And that's really the vision in terms of our approach to investing in real estate. It's hyper specific because we have access to, and we've bought a lot of land historically in this market, and we've been able to develop, create value, and attract tenants quite efficiently.
I might be going off topic, so rein me in, but I think I've been very hesitant to invest in states where they are more tenant friendly, meaning someone's not paying, you can't just evict them, within 30 to 60 days. And so, that kind of thought process of like, if I'm not willing to be an operator, I own my own real estate. I have 12 single family homes in Atlanta, and I very much deal with tenants and evictions and people not paying. And that's always, all I hear from
the pain of your existence.
And, like, don't invest in tenant friendly states. So can you talk a little bit about how that plays out in, at least New Jersey, where it's, generally considered more tenant friendly? And
Yeah, I don't think that question is off topic at all, first and foremost. Second, I 100% agree. Please do not invest in New Jersey. Please do not invest in my market. I'm very happy to have no competition and run a monopoly. I prefer it that way. But jokes aside, I think it's a very good question, because we're in an age where there's just so much information, and it's very easy to catch things that are trending and just take it as law. Fundamentally, investing in a market like New Jersey, you have to be aware of like the laws and how tenant friendly it is. But on the flip side, if you have the right criteria for screening tenants, they're very sticky. For you, Pascal, like we have assets in Atlanta, in like Decatur and those types of markets, and vacancy is a problem. And I don't know how your portfolio looks. I know it's single family, so maybe it's different. But it's one of those things that fundamentally there aren't enough quality tenants in those markets, in my opinion. Meanwhile, in New Jersey, the state has a 95% occupancy. The state is saying there's fundamentally not enough housing in the state. For us, we have over 5,000 units and a 97% occupancy. We have situations where we'll build a 24-unit complex, and in the first month, 20 units, 20, let's say, yeah, 20 will be conservative. 20 units will be rented out in the first month, and we're underwriting that it'll take 6 months to stabilize. So it's one of those situations that I think New Jersey is not landlord friendly, but fundamentally ground up construction is. So for us, we don't have any issues raising rent. People want to live in nice buildings, and the type of client you're attracting, if you have a nicer building, think of like
White collar.
like no, they're blue collar, but think of like Malcolm Gladwell and like the power of your surroundings, in the sense that if you see a dirty neighborhood, you're more likely to litter. If you see a clean neighborhood, you're more likely to keep things clean. For us, like you can't necessarily see it the best in this picture, but you have this massive, nice apartment complex building, and you have these like single family and duplexes next to it. So a lot of our tenants, they might be the same, quality tenant, income wise, profession wise, etc., but they take care of their building because they see the houses next door and how run down they are and how bad condition they are. And maybe this property in the background is a better example because it just looks like an eyesore. Respectfully to whoever owns it. But it's one of those things that for us, we have a lot of applicants for our units. They rent out quickly. The things that don't rent out quickly are maybe the commercial units in mixed use buildings. So we build less mixed use buildings. It's that simple. But circling back to your question, there are situations where you do have tenants who aren't paying. And honestly, the eviction process hasn't been horrible in our experience, because everyone is, at least in our city, everyone is gearing towards the same thing. They want nicer units. They want a better quality of living. They want the guy who's making 75K or the family that's making 120K between husband and wife. They want that person to be out of 1940s slumlord type inventory into, nicer buildings. And it kind of circles back to your point earlier, right? If you have that inventory, or if you have that person who's not making enough money, they're going to struggle to run their business, right? The person managing that 1940s inventory that maybe hasn't managed it well isn't making enough or managing it efficiently to kind of keep up with that upkeep. So for the city, they've noticed, like, before we got involved heavily, there was a lot of abandoned properties. It was like Black Friday shopping. You just pick them up, rezone land, and develop. And that's really what we've been doing, Pascal. So for us, it hasn't been a problem. It's one of the key points is that we don't really have any competition in the market. Habitat for Humanity would be our competitor in our market, which anytime you're competing against a charity, it's a good situation to be in. But it's to say that I think that there's a rationale associated with invest in areas that are landlord friendly. But the flip side is if you invest in a way where you never have the issue of vacancy, then it's no longer an issue. Fundamentally, if you're in the hottest markets in the country, you're going to attract tenants that don't want issues themselves. And because they don't want issues themselves, they're always paying on time. And that's kind of how I see it. I don't know if you agree with that mentality or not.
Yeah, I mean, I don't. I think the issue is less on attracting the tenants and more on how difficult it might be to get someone out that does not end up paying.
Yeah.
I think, I know New Jersey is a state where there is, in some areas, rent control, and there's, my understanding is that the eviction process can be significantly longer. So instead of, maybe 45, 60 days like I am, that it's, closer to 6 to 12 months, or longer. So how do you tackle that?
Yeah, so for us, we have 1 year leases. We don't have rent control because it's new construction. So it becomes a non-issue, right? It typically takes like 30 to 60 days. So it's really not it really hasn't been a problem historically. And it's also, New Jersey is a pretty high income state as well. So when you have pretty strong underwriting, you're able to attract people who can pay. And if they're evicted from here, then it's like, to some degree, where are they going to move? They don't want to move back to that like 1940s type inventory. So for us, we haven't noticed an issue. And if anything, it's been, hey, we're putting online newer, nicer product. So people from older inventory are moving into newer inventory. And then that opens up older inventory for people at like lower price point. Like this Armory project, for example, this is Class A, right? So it's a whole different spectrum than maybe this, which is like a Class B product, but priced like a Class C product. So it's really targeted to, the middle 50%. Meanwhile, this is targeted to like the upper 10%. It has a pool. It'll have like a police center. It'll have like restaurants at the bottom, etc. So it's for all intents and purposes a very nice building for this market, and the first of its kind to have those types of amenities. So I think that's the thing, because Pascal, in our market, if you go, in a 10-minute radius, people are paying $300 more a month. And these are guys that are making, as a family, let's say 100 to 120K. So really for them, it's one of those things that historically we haven't seen an issue, because they see like the value, and they're moving into these areas and they're saying, hey, we can't buy a house. So this is really our long-term solution. We're going to be renting for forever. And we're a nurse, we're a bus driver, we're a teacher, blue collar, backbone of the economy type jobs, or at least in New Jersey, those people aren't losing their jobs. And I think nationwide, those types of jobs are pretty stable, nurses, things of that nature. So I think that's really how we address it.
Yeah, no, cool. Thank you for talking about it. I'd love to. We're a little over time. I want to continue and just make sure you finish up. I don't know if we're gonna have time for questions, just to keep you on track, but yeah.
No, I hear you. I mean, that's really where we're at. I know. Like you mentioned, we're over on time. So if anyone has questions, you can scan this QR code to book some time with me, or shoot me an email at ml@velocecapital.com. Once again, Pascal, thanks again for organizing this, and I hope you and the entire group, found value.
Yeah, thank you so much for hopping on the call. It was good to connect, and thank you for showing up.
No problem. We'll speak soon. Have a good one, guys.